news events and how they impact trading in the FX markets. It's very important when you're trading the FX markets, or any market for that matter, to understand the market discounting mechanism. Now, what do I mean when I say that? Well, news that is expected is generally not going to move the market. It's when news is unexpected, or when results are different from what is expected, that's usually what moves the market. The market reaction is based on expectations. So let's suppose we're expecting for currency A that country is going to have very strong economic indicator. It's going to be released this morning, and it's going to show very strong growth. And lo and behold, that economic indicator is released, and it does show strong growth, exactly as expected. The market probably won't really react too much to this because, again, it's already expected, it's already priced into the market. On the other hand, suppose we're expecting for currency B a very strong economic indicator to be released, and when the figures are released, they come out much weaker than expected. Now there's potential for market movement because, again, the market reaction is based on expectations, and we're getting something very different from what was expected. This is called the market discounting mechanism. We want to take a look briefly at how to calculate profits and losses in the Forex markets. First of all, you have to know what a pip is. A pip is the smallest increment by which a currency pair's price can change. So we talk about a spread of 3 pips, or perhaps a trade that moved 50 pips in my favor, a stop that was 30 pips underneath my entry point, etc. The value of a pip is determined by the pair being traded and the price at which it is trading. You'll notice that currency pairs that feature the US dollar as the quoted currency, that's the second currency, those have a fixed pip value of $10 per pip. When I say $10 per pip, that refers to a standard trading account. However, there are mini accounts available. In a mini account, just think of it as being everything is 1/10 of the size of the full-sized account. So in a mini account, currency pairs that feature the US dollar as the quoted currency have a fixed pip value of $1 per pip. It's very important to note that. Mini accounts, of course, very popular with traders who are getting started out in Forex because there's very little risk involved. You can trade a very small amount of money. Okay, calculating profits and losses. Let's take a look at an example of how this would be done. Let's assume that a trader purchases one lot of the Euro-US dollar currency pair at a price of 1.2000. The trader then closes out the Euro-US dollar position at a price of 1.2100, or 100 pips higher. The profit would be 100 pips, and if we're trading in the standard sized account, 100 pips would equal 1,000 US dollars. If we're trading in a mini account, 100 pips would equal 100 US dollars in this example. Let's take a look at another key concept, which is interest rollover. Now, as we mentioned earlier, every FX transaction involves buying one currency and selling another currency. Traders pay interest on the currency that they sell, and traders earn interest on the currency that they purchased. Now, the interest rates that are involved are established by central banks and authorities. And the reason why interest rates fluctuate, why countries' interest rates change, is because countries that are experiencing rapid growth, they often increase their interest rates, whereas countries that are experiencing slow growth, they often decrease their interest rates. Now, let's take a look at an example of how this might work. Let's assume that a trader is long the Great Britain pound US dollar currency pair. This trader is receiving interest on British pounds and paying interest in US dollars. If the pound has a higher yield than the US dollar, the client will receive a net interest payment. And certainly, there are trading strategies that are based specifically on this concept, interest rate arbitrage. On the other hand, if the pound were to have a lower yield than the US dollar, the client would owe net interest. So interest rollover is very important because it does come into play in certain strategies. Now let's take a look at the central banks that impose these changes in interest rates. And first of all, a central bank is the principal monetary authority of a nation. They oversee monetary policy and they regulate credit conditions, and they are responsible for determining the interest rates of a country. The various central banks that we're going to be involved with: in the United States, the Federal Reserve Board; in the European Monetary Union, the European Central Bank, or ECB as it's commonly referred; in the UK, the Bank of England; and in Switzerland, the Swiss National Bank, or SNB, is the authority that determines interest rates. In Japan, the central bank is the Bank of Japan. We're going to talk a lot about them today. And in Canada, the Bank of Canada, or BOC, is your central bank there. Australia has the Reserve Bank of Australia, and New Zealand has the Reserve Bank of New Zealand, determining their interest rates. Let's take a closer look at the Federal Reserve Board. The Federal Reserve Board, they're responsible for setting and implementing monetary policy in the U.S. The Federal Open Market Committee holds 8 meetings per year. At those meetings, interest rate decisions are made, and frequently comments are made that relate to the future direction of interest rates. So these meetings are very closely watched for those reasons. Now, no discussion of the Federal Reserve would be complete without mentioning the U.S. Treasury, because even though the Federal Reserve determines the interest rates, the U.S. Treasury determines whether or not the U.S. dollar is undervalued or overvalued, and the U.S. Treasury can instruct the New York Federal Reserve Board to intervene in the U.S. dollar by buying or selling U.S. dollars, thereby affecting the value of the U.S. dollar in open market operations. And so because of this reason, the Treasury's view on monetary policy is meaningful to the currency market. Obviously, it's very important, because the U.S. Treasury does have that capacity that they can intervene in the market. Let's take a look at the European Central Bank, the ECB. This is the governing body for the European Monetary Union. Their executive board consists of a president, a vice president, and 4 other members, and new monetary policy decisions are made by a majority vote in the ECB. So again, you have a group of countries who are basically, all of them are basically subjected to this ECB. Now let's take a look at England, the UK. The Bank of England is a central bank of the United Kingdom. The Bank of England Act in 1997 gave the Bank of England independence in setting monetary policy. And the Monetary Policy Committee, or MPC, is the body that is responsible for making interest rate decisions for the Bank of England. The Swiss National Bank. The Swiss National Bank enjoys 100% autonomy in determining the nation's monetary policies. The SNB's goal is to keep inflation under 2% annual rate. And the SNB, of course, affects the Swiss franc with remarks about liquidity, money supply, etc. This is referred to as jawboning, and we'll speak a little bit more about that as we go. But sometimes you'll see that a central bank will try to affect the value of the underlying currency just through comments. And it's a very common practice. Let's take a look at the Bank of Canada. This is the governing body that is responsible for setting monetary policy. 7 members, the governor and 6 deputy governors comprise this. And they do not, interestingly enough, they do not have regularly scheduled monetary policy meetings such as the U.S. does. Let's get involved with the Bank of Japan here. Bank of Japan, the key monetary policy making body in Japan. The Ministry of Finance is actually in control of foreign exchange policy. So the Ministry of Finance actually determines whether or not the Bank of Japan should intervene in the currency markets, and the Bank of Japan then executes the FX transactions at the directions of the Ministry of Finance. Now, certainly Japan is not the only country, the Bank of Japan is not the only central bank that intervenes in the FX markets. However, their interventions have been sometimes spectacular and certainly the cause of a lot of conversation, and it's certainly something that we'll discuss a little bit as we go. Now, in Japan, there is a tremendous trade surplus, as we discussed earlier, because we all have products that are made in Japan for the most part. This trade surplus equals approximately 3% of Japan's gross domestic product, or GDP. And having a strong trade surplus creates an inherent demand for the yen. Think about it this way.